and more, by the way. Mahima, thanks for that. But let's talk about that and more with Aditya Suman. He's senior analyst at CLSA Johnson right now on the show to talk about all of this. Aditya, great having you. Thank you for taking the time out. And at the onset, even though it's 13 days old, wishing you and yours a very happy 2025. Though must say, for the markets, for Avenue Supermarts, it's not quite starting out like a happy 2025.
Absolutely. No, thanks for having me on the show, Neeraj, and great to be on. No, look, I mean, maybe I can kick it off with DMart since it's just reported, but I thought it was a fairly good result, contrary to what the stock reaction suggests. A couple of reasons for that. We saw, as the company mentioned, fairly intense discounting in the quarter, driven by some of the quick commerce players. Despite that, DMart has actually maintained gross margins and actually accelerated same-store sales growth, which improved to 8.5% or from sort of 5.5% in the quarter before. Now, to me, this is actually quite a positive move, maintaining gross profit and accelerating top-line growth. Yes, EBITDA is a tad lower, primarily a function of higher employee costs. But our view here is that they're really setting up for accelerating store ads. I think that's been sort of the number one investor question for them. And as a consequence, are front loading some of the costs, particularly employee costs. So I actually thought the result was positive. And would we continue to maintain our sort of overall positive view on the name.
Aditya, so the overarching feeling seems to be that while they're showing growth, quick commerce is eating into margins. And that's a trend that some people say is now visible for the last 3-4 quarters, at least, if not longer, and may well continue. So there might be growth, but there might be margin pressures, there might be profitability pressures. And therefore, why pay top dollar for something like this where there is a bit of a cloud of uncertainty here? How do you argue against that?
Yeah, no, great question. And look, our overarching view here is that we're actually positive on the quick commerce names as well. So as well as DMart, our view is that retail is shifting from unorganized to organized very rapidly. Obviously, the biggest beneficiaries of this theme are the quick commerce players as well as players like DMart and Reliance. Now, with DMart in particular, you're right that have they grown slower than quick commerce? Absolutely. But if you look at their overall growth and compare that with the FMCG sector, then they've actually managed to sort of outgrow the FMCG sector by a significant margin, which suggests that they are still gaining market share overall. So over a long term, we feel that the transition from unorganized retail to organized retail will continue. And in particular, players like DMart, which offer deep value to a large number of urban mass consumers, I think will be the biggest beneficiaries. Now, coming specifically to your question on margins, again, yeah, I think have the margins been impacted over the last few quarters? Yes, absolutely. But I think the number I track really closely is gross margins, right? If you look at what the DMart team has maintained over the years is a margin band of sort of 14 to 15% on the gross margins. They're still well within that margin band, despite the increased pressure. Now, at some point, the pressure from quick commerce will ease, particularly as all of these companies are also looking to be profitable. And that's where we feel that there will be sort of potential for DMart to sort of raise margins. But for now, the fact that they're not losing incremental share and the fact that they continue to sort of push on the private label agenda, to me is a big differentiator between DMart and some of the quick commerce players.
Aditya, hi, very good morning. Tamanna here, and we're really glad to have you on NDTV Profit. So thank you for that, and very timely day because, you know, the DMart story, and this is interesting because you also track Swiggy, Zomato, and the platform companies as well. The investor concern seems to be changing consumer trends, and how does that fit in? I want to come in on that specifically for you. If someone's watching this and they're wondering whether the next bet is DMart, and yes, they may fix themselves by Q4 or even Q1 of the next financial year, for fresh investments, shouldn't they look at platform companies instead? How would you crack that comparison?
Yeah, no, great question. So look, as I mentioned, we are actually positive on all three. So the way I would split that up is I think there is a consumer base for high value, where players like DMart or let's say Superstore by Zepto offers great value. On the other hand, there is a huge demand for convenience, which is what the quick commerce players by and large address. So we feel these are two different market segments, one for value, where it's very difficult for quick commerce on a sustainable basis to compete with players like DMart just because the cost structure being much lower. However, on a sort of higher convenience, faster moving models, we see quick commerce gaining market share. So if I were to break that down over the next 3 years, would I see much faster growth for quick commerce? For sure. On the other hand, if I were to look at this as a 5 or 7 or 10 year sort of India consumption story, then that pivot to sort of modern retail e-commerce continues, and all three companies or all three listed companies for now will be beneficiaries of this theme.
Just on one more point on DMart before we move to the larger picture. One important change as well has been the management change, and just wondering how big and how crucial a factor there is. Of course, it's happened in a smooth way. The transition has taken place. You know who the new captain of the ship is. But how do you see this as a factor that investors are looking at today?
Yeah, thanks, Amanda. Thanks for asking that. So I think an important point, right? I mean, so a lot of investor conversations revolved around whether there was sort of a need for a change at DMart because in some ways they lost ground, particularly on DMart Ready to some of these quick commerce players, and there is an opportunity obviously for DMart to accelerate that business. On the other hand, there's also calls for sort of an accelerated store rollout, particularly in smaller towns where quick commerce is not present and is unlikely to be present anytime soon. So DMart can really address cities as small as sort of 100,000 people. By and large, our view is that quick commerce will be a force in the top, let's say, 125 cities with a population of over 500,000 people. But even there, I think there'll be pockets that can only be served by physical retail. And so there is a greater focus on store ads for DMart. And I feel that with a change in management, there should be sort of a renewed focus. That's not to say that Neville, obviously Neville's been instrumental in the success at DMart, and a lot of the sort of improvements over the years have been driven by him. But a change can bring about sort of a reinvigorated workforce, which we feel is the right time, especially as they tackle sort of younger, more aggressive companies, the likes of the quick commerce players.
What's the one-line takeaway? Management change will be a concern for some time before things settle, or not?
Not really. So the one-line takeaway is I would actually say look out for an acceleration in store ads, look out for an improvement in DMart Ready.
Aditya, since you track the space and consumption is, I would say, the big question even ahead of the union budget. How are you looking at the sector? If I were to ask you to broadly divide this into potential performers and those that are going to be looking soft for a while, how would you do that?
Yeah, so our overall view is fairly clear. We, as I mentioned before, like the sort of retail companies, we feel that's a more sort of concrete way of playing consumption as a theme in India. We still feel there is going to be disruption within FMCG, particularly as smaller companies, more disruptive companies use the distribution change provided by modern retail, by quick commerce, as a platform to sort of disrupt existing businesses, the likes of the incumbents, the likes of Lever or Godrej or Marico. On the other hand, we see consumption actually remaining fairly strong. I think we called this out in our previous note that we haven't really seen a deceleration in consumption. It's only the data points that we're tracking that are seeing a shift. So to give you an example, I think if you in the previous quarter, if you looked at growth for non-metro urban India, that actually grew faster than rural India, even as per Nielsen data. It's only the urban metro growth that decelerated. And here we feel the biggest impact was the fact that quick commerce isn't as closely tracked by Nielsen or Kantar or any of these panels. And our view is that that growth is being missed. So the shift in channels is leading to disruption. That being said, I think at least for the first half of 2025, we expect there to be a rural recovery on sort of a fairly weak pace, and some of these rural-focused companies might do better. Now, our view, the best way to play this is through some of the food and beverage names, where the underlying gross margins are lower and the ability for sort of quick commerce disrupt is lower than the ability for these companies to use these new channels to premiumize. So our view on FMCG is that you play it through the food and beverage names, whereas we remain more cautious on the home and personal care names.
Got it. Okay, Aditya, lovely talking to you. We should try and talk once to you if you find the time post the earnings are over, just to get a sense of how you thought of the space at large.